The Strait of Hormuz risk is spiking, and if you're watching metals, the next move might not be the one you think. Because when energy and shipping risks suddenly jump, gold and silver don't react the same way. Gold usually moves like an insurance policy. Silver often moves like an insurance policy, strapped to a leverage engine, tied to industry, and traded in a thinner hallway. That's why silver can whipsaw harder than gold next. Here's the hard anchor that tells you this isn't just geopolitics chatter. Insurers are already talking about canceling or repricing war risk cover for ships moving through the Gulf and the Strait of Hormuz, and costs have started to spike. Some estimates suggest war risk premiums could rise sharply, adding real dollars per voyage. That's a real-world signal. When insurance moves, shipping behavior changes. When shipping behavior changes, energy risk changes. And when energy risk changes, markets start repricing everything else: rates, currencies, equities, and yes, precious metals. Now here's the second hard anchor that keeps this grounded in the metal market's plumbing. CME's silver CVOL, its 30-day implied volatility gauge derived from options, was still sitting around 89.99 with a notable daily change on Feb 27, 2026. So we're not entering this Hormuz moment with calm silver. We're entering it with silver already priced for turbulence. And that matters because when geopolitical risk spikes, people assume the trade is simple. Buy gold, maybe buy silver, and it just goes up. In reality, the path can be violent, especially when the market is already sensitive to liquidity and collateral rules. Let me make this personal early. If you're an American watching this, Hormuz risk doesn't stay over there. It shows up in gas prices and shipping costs. It shows up in inflation expectations. It shows up in your interest rates. And it shows up in the way markets swing, sometimes in a straight line, sometimes like a whip. So here's what we're going to do. I'm going to show you why Hormuz risk can push gold and silver in different directions in the same week. Why silver is more likely to whipsaw, what "be ready" actually means in practical terms, and what to watch so you don't get baited into the classic mistake, selling the flush and chasing the bounce. And I'm going to tease one watch signal right now, because it's the earliest clue this is turning into a real market event. If the Strait of Hormuz risk keeps rising, the first tells won't be your metal chart. They'll be in shipping behavior and insurance pricing. Hold that. Now, what's actually happening? Multiple reports today describe an escalation after US and Israeli strikes on Iran, with heightened fears of disruption in the Strait of Hormuz and warnings to ships in the area. And whether or not the strait is officially closed, the market doesn't wait for an official stamp. Markets reprice on risk. If ship owners hesitate, if insurers raise rates or pull coverage, if vessels reroute or pause, the effective flow can tighten even without a formal blockade. That's why the Financial Times reporting about insurance being canceled or repriced matters so much. This is where we need a quick myth versus reality, because it keeps us from turning this into fear theater. Myth: the strait has to fully close for markets to react. Reality: you can get major repricing from partial disruption, elevated war risk premiums, routing changes, or even just credible threats, because it raises costs and uncertainty. Myth: gold and silver will move the same way. Reality: gold is more purely monetary, safe haven. Silver is hybrid, monetary plus industrial, plus thinner liquidity, plus more leverage sensitivity. In stress, that often means silver swings bigger both directions. Myth: geopolitical risk means metals only go up. Reality: in the short term, risk off can create forced selling across multiple assets, especially when volatility and collateral constraints tighten. Silver can drop even while the long-term thesis looks bullish, then rip. Now here's the key frame that explains the whipsaw risk. In a Hormuz risk spike, you're not just trading fear. You're trading second-order effects: oil and shipping costs, inflation expectations, central bank reaction functions, dollar strength or weakness, and overall liquidity in the financial system. Gold usually likes fear. Silver likes fear too, but silver hates certain types of liquidity stress, especially when the tape gets thin and leveraged positioning gets forced to unwind. That's why silver can outperform gold one day and then underperform violently the next. Now, let's talk about the mechanism that makes silver more whipsaw prone. First, silver is smaller and thinner, and it doesn't take as much flow to move it. Second, silver is heavily influenced by positioning. Third, silver's options implied volatility is already elevated. CME's silver CVOL near 90 is not a sleepy market. Fourth, the futures market that drives price discovery is sensitive to collateral rules. And we've already seen CME tighten margins in precious metals during this volatility regime, including raising silver margins, reported by Reuters-linked outlets. Even if you don't trade futures, this matters, because it changes the behavior of the marginal buyer and seller, and the marginal buyer and seller set the short-term tape. Now, I want to put you into a real scene. It's not a hedge fund villain scene. It's a regular risk desk scene. A trader or a fund is positioned in silver. They wake up to a Hormuz headline, oil spikes, volatility jumps, silver gaps up. Then the next hour, the dollar firms, yields move, equities wobble. And suddenly the same fund gets a call from their broker. Collateral requirement changes, risk limits tighten, house margin increases. Now the trade stops being, I'm bullish. It becomes, I need cash. That's how safe haven narratives turn into liquidation moves, especially in silver. And if you've ever watched silver during a macro shock, you know the pattern. It doesn't move like a polite trend. It moves like a crowded hallway. A rush one way, then a stampede back, then another surge. Now, let's connect the Hormuz risk to what the market is actually worrying about. The Strait of Hormuz is not just a headline, it's a bottleneck for global energy flows, and when it's threatened, oil risk premiums can jump quickly. Oil risk premiums matter because oil is still a major input into global inflation. Higher oil risk can raise inflation expectations. Higher inflation expectations can change interest rate expectations. And in a world where rates matter, that's where gold and silver split. Gold sometimes benefits from higher inflation fear, but gold can also get tugged by real yields and dollar strength. Silver, because it's more industrial and more volatile, can get pulled in multiple directions at once. That's the whipsaw. So what does be ready actually mean? It doesn't mean panic buy. It doesn't mean sell everything. It means you prepare for a regime where intraday ranges are wider, breakouts fail more often, breakdowns reverse faster, and your biggest enemy is not being wrong. Your biggest enemy is getting forced out. Here's the line you can clip. In silver, being right isn't enough. You have to survive the path. Now I'm going to give you a simple, concrete way to understand why silver can whipsaw harder than gold in a Hormuz moment. Gold is a pure fear trade. Silver is fear plus industry plus a leverage engine. If Hormuz risk spikes and oil jumps, the first reaction can be buy metals. Gold rises smoothly, silver jumps harder. Then the second reaction hits. Higher energy costs can hurt growth, markets wobble, liquidity tightens, and forced selling appears. Gold might hold up, silver can flush. Then, after the flush, silver can rip again when forced sellers are gone. That's the classic sequence. Up hard, down hard, up again. And it's why people feel like the market is rigged. It's not rigged. It's mechanically brutal when volatility is high and the crowd is leaning the same way. Now, let's talk about what would confirm that Hormuz risk is escalating into a broader market event. This is where you stop watching only your chart and start watching cross signals. Signal 1, shipping and insurance behavior. If insurers are canceling policies or repricing sharply, if ship owners are turning away, if the war risk premium keeps climbing, risk is real and rising. Signal 2, oil pricing and volatility. Even talk of disruption can push prices higher and increase volatility because the market is pricing the risk premium. Signal 3, the dollar. Risk spikes often create a scramble for dollars. A stronger dollar can pressure commodities in the short term, but it can also coincide with a gold bid if fear is dominant. This is where gold and silver can diverge. Signal 4, rates and inflation expectations. If the market starts thinking energy shock, charge, sticky inflation, then rate expectations can shift. Gold can benefit from fear, but get tugged by yields. Silver can get tossed around by both. Signal 5, metals volatility. If silver CVOL stays elevated or rises further while price chops, that's the market telling you uncertainty isn't leaving. Now, I want to add a little debate friction because it keeps this honest. You might be thinking, but shouldn't silver just be a safe haven like gold? Some people treat it that way. But silver is not gold. Silver is more industrially linked. It's more volatile. It's more prone to positioning-driven moves. And it's historically known for punishing certainty. So if you treat silver like gold, same sizing, same emotional expectation, you're setting yourself up for the worst kind of mistake, selling the flush and buying the rebound. Now, what should you actually do? Not financial advice, just practical positioning logic. First, know your vehicle. If you own SLV or another ETF, you're trading price and volatility. If you own miners, you're trading equities plus metal exposure. If you own physical, you're trading premiums and availability as much as spot. Second, match your size to volatility. If you can't hold through a violent day, you're oversized. Third, expect two-way trade. In a Hormuz risk spike, silver can spike and then flush even if the story still supports higher prices. Fourth, keep a watch signal so you don't trade your emotions. Here's mine. Watch whether silver's big move is accompanied by widening spreads and persistent high implied vol versus a calm follow-through. Now, let's talk about why the Strait of Hormuz story can especially impact silver. Silver is used in industrial supply chains. If shipping disruptions and energy costs rise, supply chain uncertainty rises. That can change industrial hedging behavior. It can change financing. It can change risk appetite. So silver can get hit from both sides. Bullish, fear, inflation hedge narratives, currency uncertainty. Bearish, risk-off liquidation, growth fear, liquidity tightening. This is exactly why it whipsaws. Now, a quick micro story that makes this feel human. A normal person hears Hormuz risk, thinks oil up, inflation up, buy metals. They buy silver because it feels like gold, but with more upside. Silver spikes. They feel smart. Then silver flushes hard because the market clears leverage and hunts stops. They panic sell. Panic. Then silver rebounds because fear remains and forced sellers are gone. They feel stupid. Then they chase back in at a worse price. That sequence is why silver is so dangerous in headline-driven periods. It weaponizes your emotions. So how do you protect yourself? You stop treating the first move as the final move. You assume the path will be messy. You size accordingly. And you watch the cross signals instead of the comment section. Now, here's the most useful be ready checklist I can give you. If Hormuz risk is truly escalating into sustained market repricing, you will likely see war risk insurance costs remain elevated, not just a one-day blip. More shipping disruptions, reroutes, delays, warnings, becoming persistent. Oil volatility staying high and risk premium persisting. Silver volatility staying elevated, CVOL staying high. More flush then rip behavior in silver because liquidity is jumpy. And if you want one single tell that silver whipsaws are about to get nastier, you'll see big intraday ranges on days with no new information. That's when you know it's positioning and liquidity, not just headlines. Now, a strategic CTA, mid-late, not hook killing. If you want, I'll turn this into a simple weekly risk dashboard update. Hormuz shipping, insurance signals, oil risk premium, dollar yields, and metals volatility, CVOL, so you can see the setup before the move. Subscribe so you catch it when it matters, because the biggest swings don't start on your chart, they start in the plumbing. Now, let's close this with a clean recap and a cliffhanger. Strait of Hormuz risk is rising in mainstream reporting, with warnings to ships and growing concern about shipping disruption and energy supply risk. Shipping insurers are already repricing risk, which is a real-world signal that conditions are tightening. And silver is not entering this moment calm. CME's silver CVOL is still extremely elevated, signaling the market is pricing big swings. That's why silver can whipsaw harder than gold next. Gold may act like a steadier fear trade. Silver may act like fear plus industry plus leverage, and that combination can produce violent two-way moves. 10-word recap: Hormuz risk rises, oil jumps, silver whipsaws, gold steadier. Stay ready. And here's the cliffhanger. The next sign won't be a headline about Hormuz. It'll be the first day oil spikes, gold holds, and silver flushes anyway, then snaps back so fast it makes people angry. That's when you'll know the move isn't about direction anymore. It's about survival through the path.